Let's get started with one of the players in this environment, which is really the granddaddy of them all, because it's probably the largest by value, and it's also the one that's been around the longest and probably has as big a base as any, and has really gone through its cycle of maturing so that it is now in money, so to speak, because of corporate reorganization. And I'm talking here about Phuthuma Nathi. There are two versions of the scheme. We're going to have to go into that, PN1s, PN2s. But basically, in aggregate, they own 20% of Multichoice South Africa, right? Not a listed company. Multichoice, of course, is the business that owns DSTV and related platforms, MWeb and all that sort of thing. ShareMax, not ShareMax, Showmax. Got to get my acronyms correct. The market value, if you put all of that lot together, is 9.46 billion rand. And I'm adding together the PN1s and the PN2s. It's been in existence for 10 years, since 2006. So, Craig, give us the rundown, the difference between the PN1s, the PN2s. Am I correct in saying that these things don't have an associated debt structure? It's just a straightforward ownership of 20% of... So they own an entity. You own a piece of an entity that owns 20% of Multichoice.
Yeah, so you as a shareholder, you own Phuthuma Nathi shares.
Right.
Phuthuma Nathi owns 20% of Multichoice
and
South
benefits
Africa.
From Multichoice's cash flows, dividends and the likes.
Exactly. So the other 80% shareholder, as you mentioned, was Naspers.
Right.
So the deal was structured back in 2006, and the idea was that you'd pay debt off over 10 years. Debt was settled after 8 years.
Excellent.
So it it currently is a cash cow. So you didn't have a dividend yield there, but the dividend yield is, the historic yield is over 13%. 13%.
Outstanding. Yeah.
So just the yield alone makes us a very attractive deal.
Let's talk about its trading platform. This one's not listed on the JSE. What they've got is one of these sort of special purpose transaction platforms, which has got a bid and offer spread. There's a chart which should be able to be put up now, which shows how this thing has done over the last 3 years. So you can see a steady gain there from around 50 Rand a share, current level about 140. But then you can understand why it is so attractive. Is even if you buy it now, you get that yield. I guess the issue really, though, is how positive do you feel or otherwise about Multichoice's business? We know that they have competitive threats from Netflix, blah, 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 but there's still a very strong customer base of, I don't know, what is it, 7 million customers around the continent now that enjoy, it's only in South Africa, that have the premium bouquet and all that.
Yes, so look, I think we all got our letters this week saying that
Ouch.
Premiums increasing. So it was a bittersweet moment as a shareholder.
750 Rand, yeah.
That's right. So as a shareholder, it's kind of bittersweet because you can see revenue potentially increasing, but then you're going to have to pay out a bit more.
And the excuse was that obviously their content acquisition costs are often settled in dollars for the Premier League soccer and for all the new movies and all of that.
So that's one of another headwind is the currency. So that potentially dampens prospects for the current financial year because you've had the currency weakened 30%.
But don't you think, my own reading of it is, and maybe I'm being unreasonable here, is that people will suck up the pay increase because we know that the Multichoice package is so attractive and people love the sport. Those people that can't afford it are probably looking to downgrade to a Showmax type offering, provided they've got adequate internet connectivity. Yeah,
so I think there's something for the entire family there, business and sport for the old man, Cartoon Network for the kids, and then all the movies and series for mom. I hope I'm not being sexist over there, but so, you've got incumbency. People don't change very easily.
Exactly.
And I think the other Top TV, I think they were called.
We can't even talk about them anymore. Open TV, they all come and go. They've got no purchase whatsoever.
Exactly. So content is critical in the space, and they've secured
and even Netflix, to be honest, has got issues with its South African offering because they've already sold some of the most attractive series to Multichoice.
Yeah, exactly.
Okay, so what we have here is trading platform. Do you think it'll stay on that private thing? That's fine. You just Google up Phuthuma Nathi. If you qualify, you got to get an account. You got to get pre-approved and all of that, and then you can go ahead and buy the shares. Yeah, so
they currently do have exemption. So in terms of the platform they've been trading on, according to the FSB, that's not a legal exchange. And management is looking at options. So either they have to apply to become an exchange, or they've got to move to a proper exchange like MTN and Sasol have done.
Yes, which I don't entirely understand why that's happening, but for the moment anyway, the platform remains.
Yes.
Okay, my own view is I'm extremely bullish on Naspers and also on Multichoice, so I'm inclined to go hot. I know you feel slightly anxious about giving specific recommendations, but would you be a buyer of Phuthuma Nathi units now?
Yeah, so I think, when you're getting a 13% dividend yield, that's the historical yield. So it's not to say that, the historic yield, it's not to say that you're going to get 13% next year, but now that debt has been settled, and you've got this other parent, Naspers, wanting the cash to invest in other parts of the business. So I think your dividend should be quite attractive. So even if you don't get a capital return, you're getting a fantastic dividend return. And for an income investor, you're getting 7% on a fixed deposit. You could potentially get 13%, 12%
opportunity as well.
With growth as well, and a lot more tax efficient as well.
Excellent, good. So we're going to go hot on that one. Right.